So before we get into all the fun things that we're going to talk about with some of the recent data and housing, we wanted to look at buybacks because it's something that has been consistently coming up. And when you look at, so this is looking at 4Q 2021, the S&P 500 buybacks were at $270 billion. It's a new quarterly record. But if you think about what the politicians have said about energy and how it's crazy that they're buying back stock, they're very low on buybacks. And it's very important to look at the returns that have happened for energy companies over the last 10 years. Companies continued their record-breaking buybacks in Q4 and accelerated their expenditures prior to the end of the year. But it's coming from IT, from financials. So are we okay with all of these other ones? When you look at where the spending is coming in, it's energy is third on the list over the last 10 years for buybacks. So are we like, what's the point here? I don't understand. Like, are we going to ban buybacks for everything? Which I'd love. I think buybacks are terrible. And it's just a game of financial manipulation. But again, like, you have to tell the whole story. Yes, energy companies are trying to reward shareholders for sticking around through very lean years, but there's also money to go around. They've increased CapEx there, but there's also problems, as we've highlighted in August of last year, and pretty much every week, every Friday since, about the problems that the energy world faces on supply chains. So when you look at technology companies, 75 billion of their own share, they bought 75 billion of their own shares in 4Q 21, followed by financials at 52 billion. Real estate and utilities only spent 1 billion on buybacks. So, financial spent the most of 1.2% of their market cap on buybacks. But when you look at the sectors and how they've accomplished, coming from bar chart, S&P 500 information technology over the 10 years is up 465%. S&P energy is up negative 7.6% over the last 6 years. So, what are we talking about? Like, everyone keeps talking about price gouging and doing things, but it's like, but others are doing it. And again, I'm just saying that we have to have an honest conversation of, are we banning buybacks? Are buybacks now a bad thing? If, should we look at how IT companies are paying their people versus others? We know Amazon has had some questionable dealings with the way they treat their employees. So again, I just think it's good to have an honest conversation about how are we viewing buybacks and how are we viewing the returns. So when you start looking at industrial production, again, getting back into the data, industrial production was up 0.5% in February, was up 1.4% the prior month. The level now is at the highest since December 2018. So again, you're starting to see some of that industrial production come back, as we've been talking about, when you had that kind of rejuvenation of some of the inventories, but the leading indicators are showing that that's going to start to slow. So now when we look at the Philly Fed index came in stronger in March at 27.4 versus the estimate of 14.8. Now, remember, as we said when we talked about the Empire one, this is a better gauge of kind of global growth. U.S. growth. So again, still something positive for this go round in March, but the leading indicators are showing a much bigger kind of rollover and problems that are upcoming, which we'll talk about in a minute. So new orders climbed along with shipments and average work week, but delivery time stretched longer and prices paid spiked. Good news is employment climbed, although general 6-month outlook declined. So the outlook is getting worse. Prices continue to go up as we keep talking about that inflationary pressure. So now, New York versus Philly, massive divergence forming between headline PMIs, as former has fallen sharply into negative territory while the latter increases. So New York has fallen, Philly has gone up. So it's going to be kind of a mixture of when was it struck and what is their main business, which again leads to some of the underlying problems we've been talking about. So now when we start talking about Philly Fed manufacturing, expected new orders is now the lowest it's been since 2019. It's actually as low as it's been since 2016. So new orders are coming down. Delivery times going back to the highs. So again, you're seeing supply chains worsening again. You're seeing new orders coming down. So again, you had kind of this last push in Philly, and now a lot of these leading indicators are pointing to a bigger slowdown. Prices paid back to the all-time highs. Prices received, still not to the all-time highs, but getting close to. And based on prices paid being the leading indicator, it means prices received are going to push back up. So now when you start looking at Richmond Fed manufacturing, it's the expectation was for 2, came in at 13, so better than expected, but expected new orders, big decline. Again, all of these things are just showing you the problems that are coming into the system and how things are going to continue to deteriorate and get worse. Is it going to be a straight up recession yet? No. But again, you're starting to come into this negative growth. So Q1 is going to finish at a strong point, but this is all showing you that Q2 is going to be a very big concern for growth. Are we able to eke out some growth, or are we going to start going deeper negative? And is the recession going to quote unquote start in Q2 and then be finalized in Q3? Because for those that don't know what that means, for economic terms, a recession isn't until you have two quarters of negative growth. So again, that's going to be something to watch. Now, prices paid did come down a bit, and prices received also came down. But as we keep saying, we just expect it to go sideways and waffle up and down. So now as we start looking at the Conference Board leading index, the leading index still looks strong year over year with 7.6% gain. So again, you're starting to, it's still leading okay, but you're starting to see some of the cracks form. Now, U.S. existing home sales. So supply of existing homes has ticked up slightly, as you can see, very slightly, but remains near record low. Would currently take just 1.7 months to sell all available homes. So again, there's still that supply piece, but let's start looking at some of the other pieces to it. Existing home sales are facing pressure again, with recent decline rivaling what we saw in January of 2021. Yet back then, mortgage rates were not rising swiftly. So now you have the when you look at the Freddie Mac U.S. Mortgage Market Survey, you're coming into almost you're at 4.16%. And home sales are starting to slow because, again, you're going to see a little bit of this convergence because people are going to struggle with the down payment, as well as, well, what is it going to cost me to spend this money as rates continue to go up? So here you can see new home sales were weaker at negative 2% versus the estimate of a positive 1.1%. And it was 8.4% in the prior month, which was a large downward revision from negative 4.5%. Median new home price was up 10.7% to $401,000. Average selling price at $511,000. Month of supply went from 6.1 to 6.3. So prices are going up as new home sales are starting to slow. So typically sales slow, and then you start to see a bit of a rollover in that pricing, especially as rates continue to go up. So then U.S. housing affordability is down to 2007 levels. And as the 30-year continues to go up and prices kind of stay sticky here, because remember, prices are set by buyers and sellers. So if the buyer goes away, the seller's like, well, I'm not taking my price down because we just, that guy across the street sold his house 3 months ago for, the price that I'm offering, and my house is nicer. So you get this kind of stickiness that remains, but that's when you start to see some of the pressure coming to the downside. Existing home sales came in at negative 7.2% in Feb versus the estimate of negative 6.2%. Inventory level was second lowest on record. Builders continue to face higher material costs, especially given what's happening in the front of Russia, Ukraine. So again, you're kind of getting this kind of sideways move, which we think is the prerequisite to something bigger moving to the downside. And then when you look at the construction pipeline, permits are still elevated, starts are still elevated, but completions are struggling due to all of the supply chain issues, which again is going to keep things a bit capped. First-time buyers continue to be squeezed out. So if you're trying to buy a home for the first time, good luck. There's more than enough stories of people saving up, putting down 20%, getting a mortgage, and then getting trumped by someone who is putting down either 50% cash or all cash and paying 25% over asking, which again, first-time home buyers just don't have the ability to do. So home ownership becoming less affordable. The share of income needed to afford a median price home is rising to 32.9%, bringing home ownership affordability to the lowest level since November of 2008. 2007, 2008. These are not very good years to be consistent with when you look at economic growth and just where the world is going overall. So now when you start looking at housing starts, stronger in Feb, up 6.8% versus the expectation of up 3.8%. And then building permits were down 1.9% versus the estimate of being down 2.4%. So still new starts, still things. Again, there's volume out there coming online. The question will be how quickly and at what price, because as feedstock, as input costs continue to go up, it's going to be very difficult to see, again, sales continue to move at this level. But what did the builder pay? So if the builder is facing supply chain issues, is facing all of these problems, their costs are going to be higher. So they have to get a higher price to break even. And as we saw in 07, 08, things can come to an all stop fairly quickly. So then March home builder sentiment fell to 71 versus the estimate of 81. Present single-family sales fell to 5-month lows. Future single-family sales at lowest since June 2020. Prospective buyer traffic rose to 2-month highs. So prospective buyers are still there, but sales are slowing. So essentially they're still looking, but what is the price? And I think you're starting to see that come through. So there's still a lot of confidence, but again, as we've seen before, the confidence remains and then ends all at once. So take that with a grain of salt. But then when you look at single-family unit sales for the next 6 months, you can see that it's back down to where we were in 2019 as the MBA purchase index continues to fall and is now below where we were in 2021 and 2020. So again, all things pointing to that continuous slowdown. So that's what we have for you for the rest of the U.S. Now, in the next segment, we're going to go into Europe. Fairly short, not a lot to talk about versus what we covered last week. So, we should be able to get through that fairly quickly. So stay tuned.